This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney.
And I'm Paul Allen. The top stories this hour. Asian stocks set for gains as news of a possible US-Iran deal sends Wall Street to record highs. A tentative plan to extend the ceasefire by 60 days now awaiting President Trump's approval.
Anthropic's valuation tops OpenAI after a new funding round, while Bloomberg learns it's also pursuing a record $36 billion chip financing deal.
Also ahead, Dell shares soaring more than 35% in late trade as its outlook blows away analyst estimates. The company saying the AI opportunity showing no sign of slowing.
And coming up on Bloomberg Tech Asia, we are live at the Tokyo Humanoid Summit, tracking the rise of the robots with Google, DeepMind and Honda. Let's get you the setup for trading across Asia, and we see that relief when it comes to some further positive geopolitical developments. We're waiting for President Trump's approval when it comes to that extension of the ceasefire agreement. But we are seeing Asian equities really poised to take advantage of that bullish sentiment. We saw gains in US stocks and treasuries overnight. These reports suggesting Washington and Tehran were nearing that deal. So that's the setup when it comes to Asian equities. Take a look at the key factor when it comes to oil, though, because we did see oil edging lower after we had the tentative agreement to extend by another 60 days. We are seeing New York traded crude down by about 0.7%. Potentially, we could see shipments through the Strait of Hormuz to resume as well. President Trump, though, just to remind you, has not yet agreed to that deal. So let's get more on where we're at in these talks between the US and Iran. Further talks expected when it comes to Tehran's nuclear program. While it is raising some hopes that we have had this 3-week period of truce, of course, markets have been waiting for a little bit more substantive development to try and near this war, which is in its 4th month. Take a listen.
The teams have been going back and forth, and President Trump has made it very clear, he talked about it at the cabinet meeting, that he has several red lines. And Iran has to turn over their highly enriched uranium. They cannot pursue a nuclear weapon. And the Strait of Hormuz, back to your question on energy, has to free transit. Navigation of the seas has to be free and open as it was before. So he's not going to take a bad deal. He's going to make a great deal for the American people.
We're joined now by politics editor Laura Davidson for more. So, Laura, where are we at? Because for a number of days now, there hasn't been a great deal of substantial development.
Yes, this is really we've had, again, some heat today, but not a lot of light in that there's a deal that Axios has reported, as well as Bloomberg, that has been agreed to essentially on the staff level, lower level officials, that would essentially be a 60-day truce to extend the ceasefire, as well as, kind of the phased opening of the Strait of Hormuz and kick the talks about the future of Iran's nuclear program down the line. The key question is, though, do the two leaders of the two countries agree? Trump has not yet signed off on this. Axios reported he needs a couple more days to review this. And again, the Iranian side has not yet confirmed that they have also gotten full sign-off from their side. So this, again, appears to be quite stalled. We had a glimmer of hope last weekend. Trump came out and said that there would be a deal announced within a couple hours. He stayed at the White House over the weekend. He skipped his own son's wedding to hash this out. Nothing much came of it. So there was, sort of a flitter of optimism. We saw that in the markets when this first was announced, but not clear, if there's actually going to be movement here in the coming hours or days.
Yeah, J.D. Vance said a short time ago that Iran is negotiating in good faith, but how much progress are we really getting here? And is there a sense that maybe Iran's looking to run out the clock on this until the midterms?
This has really sort of become one of the issues here. We've heard Trump made a couple different comments saying that he's actually willing to kind of wait this out as well. The conventional wisdom had been that Trump needs to make a deal to get energy prices down ahead of these November midterms. We heard him say at a cabinet meeting yesterday, quote, "I don't care about the midterms," much to the chagrin of party officials and members of Congress of his own party who are really hoping to put this unpopular war behind him. Trump is kind of sees this as a legacy issue and, is perhaps sort of willing to run out the clock. As Iran has shown that they're also willing to do. So this could mean a much more prolonged negotiation period if Trump isn't constrained by some of the kind of political considerations that people thought would put some bounds on these talks.
We saw consumer spending, the PCE numbers, really reflecting some of the ongoing pressure now from higher pump prices, right? Savings are falling. We're looking pretty flat at the moment. We're seeing personal incomes that are adjusted for inflation headed in the wrong direction too. So, if he says the midterms doesn't matter, we're seeing another 60-day extension that takes you through that crucial summer driving season, right?
Yes, potentially. I mean, this is kind of a really interesting moment that we're in terms of, kind of the normal political considerations seem out the window. A president who's facing, the approval ratings he is, less than 30% in some polls on his handling of the economy. Consumer sentiment is at an all-time low. You see inflation really start to kick in just as, people are heading out on summer vacations and, of course, buying all sorts of supplies, when kids go back to school in the fall. This is, voters show that they're not happy about this, but Trump doesn't seem to have quite the same giddy-up behind him that both his Republican allies want him to have, as well as past presidents Biden might have had, facing sort of a political crisis here.
All right, that's our politics editor, Laura Davison there. Well, Asian equities are poised to advance after the Iran news spurred gains in US stocks and treasuries. Let's get to Bloomberg MLive macro strategist David Savage. So, David, what's market pricing telling us about the chances of a deal between the US and Iran, or is there a bigger catalyst here, namely the AI trade?
Good morning. I think it's both. I mean, equity futures are pointing to another very strong day here in Asia. The context here, of course, is that the Kospi index over the last 6 days is up some 12.5%. Yesterday, we saw what looked like perhaps markets were going to take a breather. The Kospi index was down as much as 4.7%. It, almost fully erased those losses by the end of the day. So the impulse to buy any sense of weakness in these markets that are being driven by this AI trade is really, really strong, and retail has really been at the vanguard of that, continuing to pile into this. But we see this really across managers. We had overnight a story about South Korea's National Pension Service, them increasing their year-end domestic equity allocation. So, this is a common dilemma for investors on this narrow rally where, this explosive gains that we have in a couple of these winners makes investors' portfolios increasingly concentrated. And so they're either forced to mechanically sell down those or accept that concentration. And so there are reasons to think that markets could take a breather, particularly if some of the optimism that we're seeing drive this higher open, kind of fade. But the pain trade for equities has certainly been higher.
David, when it comes to the outlook for bond yields, is it really that clear? Because on the one hand, perhaps if you get lower oil prices, that removes some of the, at least, recession risk, right? But is it straight up disinflationary if you take into account how much AI spending there's going to be?
I think that's exactly it. And I think also, yes, if we look back in the last several weeks, oil prices have come down. But if we look at sort of the rate of change, certainly on a year-on-year basis, it's still a real tailwind for where inflation is going. And so we know the direction of travel for headline inflation, particular, is going to continue to move higher. And as you said, there's also reasons to think that growth remains fairly resilient. And all of this AI CapEx spending that shows no signs of slowing down is also not just an impulse for higher inflation, but also for higher growth, both of which puts pressure on bond yields. So we saw the real sell-off in bonds, just a week ago, and we've seen that really come off as we've seen oil prices come down. So I think there's certainly a risk that, especially if we saw oil prices start to tick back higher, that bond yields could move higher as well. But either way, I think the direction of travel for bond yields in the near term, particularly at the long end, is higher, because unless the Fed really starts to signal that they're going to front run some of this inflation and really start to pivot, they're going to be behind the curve of where headline inflation is.
David, to what degree is inflation only really a problem for the bond market at the moment? Is it really reflected in what we're seeing on the equity side?
I think on the one hand, if we look at the parts of the market particularly exposed to the AI trade of, what is the impact of what higher rates might do there, I think in the near term, it's unlikely to be the catalyst that really reverses the rally, because as we saw yesterday with the Bank of Korea, they revised their inflation forecast higher. They revised their growth targets also higher. And so that puts an upward pressure on rates. But I think in an environment, macro backdrop, where you have generally an accommodative policy backdrop, but also accelerating inflation, accelerating growth, that's not going to be the environment that we're going to see equities really sell off into. So I think some of this mechanical flow is more likely to potentially be a catalyst for a near-term breather. So we have the effective rebalance state for the MSCI today, and certainly in Asia we've seen. And in the U.S., we've seen retail, really being the last, buyer of resort. So I think that's more the risk rather than rates.
All right, Bloomberg M Live macro strategist David Savage there. Still to come on the Asia trade. Mitsui eyeing global expansion of its LNG business as AI data centers drive growing energy demand. We'll hear exclusively from CEO Kenichi Hori. More to come. This is Bloomberg.
We are in the middle of the largest energy security threat in the history. Many countries are now reshaping their energy policies, reviewing their energy policies, and as a result, investment decisions and strategies are being calibrated or redirected.
That is the IEA Executive Director, Fatih Birol, at a press conference in Paris. Let's take a look at how oil prices are behaving at the moment in the wake of this potential 60-day ceasefire extension between the US and Iran. The president yet to sign off on that. This is according to sources on the matter, but that is enough for crude prices to retreat a little. WTI at the moment, 88.46 a barrel. We've got Nikkei futures kind of flat at the moment. Similar story for S&P futures, although it was another very good session for US stocks, seeing record highs, Dow in particular soaring after the bell. Well, let's get to Carol Schleif now, Chief Market Strategist at BMO Wealth Management. Carol, thanks as always for joining us. And I do want to start with the situation in Iran. Oil prices easing, obviously, potentially some good news for inflation there as well down the track. But to you, what is the market telling you about pricing in terms of the end of this conflict in the Middle East?
Well, on the one hand, stocks in particular have really tried for weeks to move beyond what's going on in the Middle East and really leaning into focusing on fundamentals and on the big growth story that we have in terms of the transformational build out of technology in so many different corners of what's going on, and reinforcement of the grid. Lots of stuff going on that has less to do, if you will, and markets have a very short attention span, especially as it relates to tolerance for geopolitical things. And so markets have been trying for weeks to move beyond that. The higher rates gave it some pause last week, but equities treat higher rates differently than fixed income does, because a little bit of higher rates translates through to higher prices, and especially when companies are using leverage, it helps the equity shareholders because it leverages their returns to the upside as well.
So a little bit of higher rates, okay, but I mean, inflation does remain a concern. It's difficult to say how much higher rates are going to go. So what's your outlook around that front, and how's that informing your decision making?
We think that we've been actually underway duration, if you will, and sticking to the higher quality fixed income all for many years, actually. And we still think it's too soon to go grab some of those higher rates farther out the curve, because you can get plenty of higher rates at the short end of the curve. But that said, we still think that that fundamental story continues to come through. Companies, consumers have responded to shock after shock after shock. And while they feel a lot of pain, the muscle memory is very acute, and they've gotten very good at being able to absorb that. we think inflation will be relatively well contained, if you will, and won't necessarily step up much higher from here. And most of the inflation, understanding it and parsing it through, it's because of that growth pull, that demand pull, and you're seeing most of it in the technology sector right now, aside from the frontline inflation that all of us consumers are definitely feeling. But the lasting sort of inflation. Go ahead.
No, sorry, I was going to ask, I like that you're, as you characterize it, US consumers are crabby, but they are still employed and they are still broadly spending. Do you think that changes, though, as the pressure goes on, if we have a summer and a back-to-school spending season that is marked by higher oil prices and affordability issues? Because the PCE numbers show that there is starting to be a turn there.
There is a turn. It's also important, though, if you zoom out, we wrote about consumers in depth a couple of weeks ago in some of the stuff that we do internally here. And they don't tend to wiggle very much as long as they're employed. And as long as the employment stays, that should steady. I think where those really frustrated consumers show up more is at the ballot box. And there is a big opportunity to turn some things there because, the sad fact is you've got a small tier of consumer that is definitely driving the aggregate numbers. So those aggregate numbers will probably stay pretty healthy even through the back to school season. It will impact some individual retailers. It'll impact where they're shopping and how they're shopping. We heard over and over again in this retailer report season about consumers being very choiceful, and they're definitely choosing where and how they spending up on some entertainment, if you will, but really being frugal where they have to be. And you did see the shifts, as you alluded to, in the underlying numbers today, that in order to pay for those higher gas tank fills, they're giving up some other things elsewhere. So it's something we're definitely watching. But as long as the employment stays pretty steady, and we've had good numbers out of the employment market, or reasonable numbers, especially when you strip out retirees out of the total weight, or the total working population. The working population, the percentage in the market has been pretty steady.
Carol, I wanted to get your view on tech. Obviously, as a sector, it's really hard to bet against at the moment. How are you, I guess, looking for opportunities? Because there's a great story in the Bloomberg talking about Micron, for example. This is a third best performer on the S&P 500 so far this year. At the same time, it's one of the most cheaply valued when it comes to being 10 times estimated earnings on how it's trading at the moment. There's an argument that the cheaper valuation might actually be counterintuitive. Maybe it means that expectations for earnings growth has actually peaked. Do you look for value, or do you look for perhaps even a higher multiple because there is a sense of security there, I guess, in that exuberance?
Yeah, well, we would love to see the markets broaden. They've tried broadening several different times in the last year or so. And for this rally to be sustainable, number one, we'd love to see it go sideways for a while to absorb some of the gains, because even though new highs tend to beget more new highs, it's still a little nerve-wracking as an investor if every day it keeps creeping up and you don't see some of that sideways movement, because you are priced for perfection. But seeing markets broaden and seeing it broaden into other categories, and actually when you look at the category breakdown of who participated in this last earnings season, it's across the board. So there's a lot of good earnings out there. But you've also had sectors, a variety of sectors, financials, where they've got loosening regulations, they've got record trading and M&A profits, and yet some of the financials, especially those that manage big positions in private credit, those names are down hard. So there's pockets and places to look, but it's hard if you want to participate in the markets. It's hard to ignore the fact that technology and communication services are 40+% of the index. So you kind of have to be a player.
Carol, always great to chat with you. Carol Schleif, Chief Market Strategist at BMO Wealth Management. More ahead here on the Age of Trade. This is Bloomberg. Anthropic has raised $65 billion in its latest funding round, valuing the company at $965 billion, eclipsing its rival OpenAI's value for the first time. A Bloomberg AI reporter, Shireen Ghaffari, joins us now from San Francisco. So, Shireen, tell us about these numbers that we're seeing and how meaningful it is that we are starting to see this overtaking when it comes to Anthropic's valuation.
That's right. It's a fierce race between the two kind of leading AI startups here for valuation, and they're both eyeing an IPO as soon as this fall. Anthropic has seen a big rise in popularity with its coding agent, Claude Code, and really gaining market share with enterprise customers. So yes, for the first time now, Anthropic, which a year ago was definitely seen as the underdog in this race, has now eclipsed value at a $965 billion post-money valuation. That being said, OpenAI last raised earlier this spring, so it remains to be seen, ultimately at what price these companies potentially go public with.
Shireen, we're also anticipating some new models coming out from Anthropic in the next few weeks. What can we expect to see here?
That's right. So there were many headlines written about Anthropic's Mythos model, which gave quite a scare to government, the general public, because of the potential cyber capabilities of this model. And so for that reason, Anthropic didn't go with a wide release. It started a project called Glasswing, where it only gave access to this very powerful model to a limited set of partners. Now, as we have reported, Anthropic has said that it is looking to do a wider release of this Mythos model in the coming weeks, and that it is more confident now that it can safeguard the potential misapplications of this product.
Shireen, I wanted to ask about some of the work that you've done on sort of AI developments and progress more generally. What is the next inflection point that's being seen when it comes to, I guess, adding intelligence to these models?
Yeah, that's a great question. I think that while we have seen quite a bit of progress from the early days of ChatGPT, there's still a long way to go to get to the true kind of original promise or goal of these AI labs, which is to create an AI that can sort of inarguably be better than any human at any task. Right now, while we see AI really be applied in areas like coding, the firms are still looking to make sure that they can see those gains, not just in one sort of sector of intellectual work, but all areas of, basically intellectual tasks out there, right, of white collar labor. And so there are many research breakthroughs along the way that these firms are seeking.
All right, Bloomberg's AI reporter Shireen Ghaffari there. The latest now from the corporate front. Dell shares soared in late trade after its full-year sales outlook far surpassed analyst estimates, fueled by demand for servers that power AI work. The company sees fiscal year revenue reaching about $167 billion, including $60 billion from AI servers. COO Jeff Clark says the AI opportunity shows no signs of slowing. Japan's Taiyo Yuden says demand for its AI server components has hit what it calls scary levels, straining capacity and raising supply chain risks. CEO Katsuya Sase told us the pressure is extremely intense as the industry relies on a handful of suppliers, leaving it exposed if one falters. And a key maker of NVIDIA servers is also sounding the alarm. Taiwan's Waiwin warning of shortages in key components beyond memory chips that could slow or raise the cost of the global AI build-out. Haidi.
Coming up on Bloomberg Tech Asia, a deep dive into the growth of the humanoid robot market. Sherry will be live from the Tokyo Humanoid Summit.
Got some breaking news out of Japan for you. It is Tokyo's CPI numbers for the month of May and mirroring what we saw nationally last month, slowing of inflation in Japan, 1.4% on year, stripping out those volatile aspects like fresh food, energy as well. It drops to 1.6. The expectation was for 1.8%. So signs again that inflation may be cooling in Japan. We also had jobless numbers. The jobless rate also coming in lower than expected, 2.5%. The expectation was for 2.7%, mirroring what we saw in the month of March. The job-to-applicant ratio holding steady at 1.18. We do have a very weak yen, of course, at 159.26, and we're waiting also for data out of Japan later on just how much intervention we saw trying to support the yen earlier this month.
Yes, and I suppose the question of the futility of those intervention measures, right, as we hover around that 160 level for dollar yen. But take a look at what we're watching ahead of the start of trading. We've got Asian stocks really set to rise there, as we had, of course, US stocks hitting another record high, firming US-Iran sentiment at play there. A little bit of lower oil prices also helping the cause as well. Of course, 0.4% softer there. We're seeing S&P futures also looking pretty positive. When it comes to gold, it's an interesting one. It feels like it needs probably a more dramatic catalyst to either go in either way with momentum. That negative correlation to oil and yields in the dollar explains why we did see that rally overnight, but not a great deal of a dramatic movement when it comes to precious metals at the moment. Well, global attention indeed fixed on the ongoing negotiations between the US and Iran, but there is a quieter risk that is building in Southeast Asia. Satellite images and ship tracking data show an increasing presence of Chinese military-linked vessels around reefs and islands, also claimed by Vietnam. Let's get more on Bloomberg's Big Take. Today, we'll talk to our East Asia government editor, John Herskovich. And John, what has been going on in the South China Sea? And of course, so much of this can also be contextualized by the distraction in the Middle East for the US. Has this increased security risks in this part of the world?
Sure. I mean, what we've seen in the South China Sea is, apart from China building out its features there, is that Vietnam has aggressively, over the past few years, built out its features in the South China Sea. Usually it's been about over the past 4 years. So what we did in the Big Take is we took a look at satellite images over 4 years, 4 or 5 years, to show how these Vietnamese features have been built up, how they've gone from like small outcrops to landfill, to putting things on these islands, such as radar facilities, perhaps facilities that could be used to store ammunition. And this helps Vietnam to assert its claims in these disputed territories. As this has been going on, we tracked shipping data to show how China's Coast Guard, maritime militia, research vessels, and other vessels linked to the government have been increasing their patrols of these islands. So as Vietnam builds more, China has been sending more of its military-linked assets to these islands to keep an eye on them. It's a slow-motion conflict that's been playing out over the past few years. We broke it all down, and it's just going to increase in intensity as the years go on.
John, what are the implications for competition around resources, energy, fish, that type of thing?
Exactly. The more that Vietnam can build in the South China Sea, the easier it is for them to make claims to these resources. But China is doing this as well. You have a huge area. The Philippines are involved. All of the countries that border the South China Sea are trying to get into these resources. And these are also crucial shipping lanes. So the global economy is affected. The economies of the countries in the region are affected. And you've seen a lot of aggressive moves. China's been the most aggressive, but Vietnam is stepping up with these developments of these features, putting more and more on them, building them out to make them larger. So it's an escalation in a very troubled part of the world, which has a lot of resources and is home to a lot of shipping upon which the global economy depends.
Did the China issue, the increasing assertiveness of Beijing, factor into the visit of the Philippine President Marcos to Japan this week?
Of course, whenever, China and Japan and the Philippines both have territorial disputes going on with China. In Japan, it's in the East China Sea. With the Philippines, it's the South China Sea. They're both concerned about Chinese vessels in the region. We've seen, Chinese Coast Guard vessels take on Philippine ships, water cannons, things of that sort. So they both have the concerns about what they see as China's assertiveness in this part of the region. the U.S., I mean, the Philippines and Japan both rely on the U.S. as a security partner, and that relationship has also been realigned with the Trump administration. But the thing is, with the Philippines and Japan, the relationship is on a pretty steady path. It's one of the easier relationships for both countries to maintain. So this visit by President Marcos to Japan, it helped to reassure what has been going on, help the two countries who are facing difficulties with China and how to balance the relationship with the U.S., get better aligned, keep their relationship strong. And we saw some agreements come out of this, from security to economics. And Japan is also looking to increase arms sales overseas, something new for the government, and it's happened under the Takaichi administration. And the Philippines could be a purchaser of some Japanese weaponry as Tokyo looks to sell its arms to other parts of the world.
Bloomberg East Asia Government Editor John Herskovitz there, thank you. Now you can also hear exclusively from the Philippine President in the latest episode of Latitude, as Linda Amin asks Ferdinand Marcos Jr. about his family's controversial legacy and the political feud with the Dutertes. That's coming up at 8 p.m. Eastern Time this Friday.
All right, we are seeing, Paul, quite a bit of optimism to round out this week, right? Asian equities poised to advance after we saw the US and Iran reaching, could be a tentative deal to extend that ceasefire for another 60 days. We understand it's under consideration for President Trump at the moment, but markets are really rolling with it. We had US stocks hitting a record high overnight, and that is feeding through to some more optimism for S&P futures at the moment as well. Futures, when it comes to this part of the world, Japan, South Korea, Hong Kong, all higher in the early part of the Friday session. We're seeing the optimism for 0.6% higher for Sydney stocks as well, which is quite interesting given that we have seen that market as being perhaps a little bit subdued given the recent fall in oil prices. But speaking of Japan, Japanese trading house Mitsui looking to invest in liquefied natural gas projects across the Middle East, the US and Australia to meet rising power demand from AI data centres. Speaking exclusively to Bloomberg, CEO Kenichi Hori also called for an urgent reopening of the Strait of Hormuz.
Yes, we need to make sure that the safe passage of vessels is resumed, and the Middle Eastern countries are going to continue to be the critical suppliers of energy products to the global markets. We cannot forecast when that will be resumed, but we just hope that we see an early recovery there.
What will give you confidence?
Safe passage of the vessels and geopolitical stability.
In the meantime, your U.S. gas business is a big driver of earnings at the moment.
Yes.
How are you doing there?
At the moment, it's doing as planned, perhaps a little bit above our plan. We do have investment in shale gas itself. We also have investment in the liquefaction facilities. So it uses U.S. natural gas converted into LNG. We also have chemical plants that convert the natural gas into gas chemicals, such as methanol and ammonia. And we have dedicated vessels lined up for the export part of these molecules and also for LNG. So it's a long supply chain, and it starts from the natural gas produced in North America.
Is your business there enough, or do you have more plans for expansion?
Always looking for expansion opportunities, yes.
In what sectors and where?
In LNG, and also for the gas chemicals that I talked about. We are working on a ammonia project. The sequesters its carbon emissions, so it's a clean ammonia. That's another project that we're working on in the United States.
How big is your U.S. business compared to the rest of your of Mitsui, and what's the plan of expansion?
The U.S. business represents more than a quarter of our net earnings at the moment, and our policy is our plan is to expand it further.
How has the war in Iran and various geopolitical flashpoints around the world in recent years perhaps changed the global energy dynamics, when a lot of these issues, such as sanctions, perhaps are being put on the back burner because the world desperately needs fuel?
The world desperately needs fuel, and the world needs to have more production sites that are reliable and competitive. So this is now an equation of trying to add more sources. And the Middle Eastern sources will continue to be very important. I think it will continue to be critical to the global supply. And with this the situation in Iran at the moment, the long-term supply-demand situation will tighten. That means that we need to have various projects that are in the works now to be completed, so that the energy industry can continue to meet the rising demand for energy.
Which is why you're traveling so much. I mean, before we started this conversation, you were telling me you're going to Australia, you're going to Latin America, Europe, so forth. So where are you diversifying?
Yes, we're diversifying into all parts of the world. For our LNG business, of course, Middle East, North America, Australia, and Africa as well.
What are the bright spots for your business?
The bright spot for our business is that for energy, there's a clear demand for growth. With the advent of data centers and the necessary energy for compute, clean, affordable, and sustainable energy is really key. In order to make that happen, we need to be part of good projects that have a lot of quality reserves. So we're fortunate to be in such a situation in some of our assets. So I think we're in the right direction.
Because of the need for these power-hungry data centers, perhaps, as you mentioned, the advent of artificial intelligence, we are seeing some governments also trying to rein in these exports, like Australia when it comes to gas from 2027. Do you expect more governments to try to keep their energy security within their borders, and what would that mean for Mitsui?
I think the governments, most governments, are very true to the commitments they made to the global markets, so for their export permits and for their export activities. And I think it's also natural that the players are mindful of domestic demand as well. Mitsui in Australia works on both ends. We also develop gas for Australian domestic use, and also we export gas for LNG. So I think for us, we like this balanced approach.
That's Mitsui CEO Kenichi Hori speaking exclusively to our colleague Sherian in Tokyo. And you can check out the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews, all our Bloomberg TV shows, documentaries, reporter analysis and more. Check out bloomberg.com/videos. This is Bloomberg.
We'll take a look at what we're watching when it comes to some of these US assets as stocks hit another record close, a record high, I should say, in the overnight session on the really optimism that the Middle East conflict may be reaching some sort of agreement, or at least that tentative truce to be extended by another 60 days. President Trump hasn't agreed to that yet, but we understand it's under consideration. And moreover, it is just optimism that the work continues when it comes to ending the war that has really ignited that oil-driven surge in global inflation, right? Take a look at what we're seeing with the dollar, which really at this point is not much, but in the context of it having just hit in the session a 7-week high on a trade-weighted basis. So over the last 6 weeks, we've seen sort of relative positivity that we are going to see a resolution to the Middle East conflict. What we are now seeing is that Bloomberg dollar really maintaining that resilience. Still, though, positioning potentially still reflecting a softer dollar view through the fact that we're seeing still some rate differentials perhaps coming back into play here. The 10-year yield still at 4.5%, and still potentially that first round energy inflation still seeing that pass through just when it comes to the inflation numbers, the consumer numbers, the PCE data that we had suggesting there is some softening when it comes to the US consumer right at the start of that key summer season there as well. Treasury is there on the rise as we see that geopolitical optimism and the possibility of a breakthrough. Also, that key US inflation gauge rising less than expected there. 0.4% overall was the PCE number, 0.2 once you remove food and energy, lower than what the markets and economists had been expecting. Well, the St. Louis Fed president says policymakers need to be open to a possibility of an interest rate hike given current economic conditions. Alberto Musalem told us that he agrees with Fed officials who wanted to drop the easing bias from the April statement.
Their real policy rate right now is running at around 0.5%, which is lower than the 1% that the committee believes is the neutral rate. I think you have to look at the full picture, and it looks to me like policy is at or slightly below the committee's long-run neutral level.
But if you combine that with the other things you talk about, you had emphasized the risks of the inflationary pressures on the demand side and the supply side of the economy. It sounds like you think they should be leaning towards tightening. It sounds like you might have been one of the policymakers in the April meeting who actually thought they should have removed the statement against tightening in the statement.
So yes, I supported the interest rate decision, but I thought the easing bias was no longer consistent with the outlook and the balance of risks, which in my mind, the balance of risk has shifted a little bit towards the inflation side and less towards the employment side. Whether the economy will require a hike or a cut or a hold will depend on the scenario. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two. And in that scenario, the economy will probably require a hike. There's also a scenario where the economy weakens materially in the second half of the year because real incomes are challenged and corporate margins are challenged. In that scenario, inflation could come down. In that scenario, we would be thinking of no hikes, maybe even a cut. So there are two scenarios to play with here.
But looking down the track, at least the markets are now fully pricing a rate hike by March 2027. Given where we are now, how we think things are going to proceed with oil prices and some of the risks on the supply side that you talk about, do you think that's a sensible thing for them to price?
Again, I think there are two scenarios here, and I don't comment normally on market pricing. I'm more focused on what's best for the economy and for Main Street. Markets have repriced materially in the U.S. and in other countries in the front end of the curve. I think that's markets trying to understand what our reaction function is.
St. Louis Fed President Alberto Musalem there speaking with Bloomberg's Stephanie Flanders at the Reykjavik Economic Conference. Right, let's take a look at the yen. Suffice to say, it's still pretty weak, knocking on the door of 160 at the moment. And Tokyo inflation for May that we got a short time ago, not really doing anything to support it either. The key inflation gauge cooling to the slowest pace in 4 years. That's going to make life a bit more difficult for the Bank of Japan, which was hoping to normalise rates, but the current pace of inflation suggesting that window may be closing, Heidi.
Yeah. We are also sort of gauging the path for the BOJ ahead, right? It kind of, the inflation number showing that perhaps some of these official programs successfully easing the cost of living issue there. Policymakers still very, very much wary as to what we see from the impact of energy prices and the war in Iran. We are getting some more data just crossing the Bloomberg when it comes to retail sales year on year. We're seeing really a beat, 2.1% high. Expectations were for 1.3%. Month on month is a gain of 1.3% against expectations of less than 0.5%. Department store supermarket sales seeing a gain of 2%. We're also getting factory production data as well. Industrial production there seeing a gain of 0.8%, really bucking the expectations of a contraction of 0.6%, and year on year a gain of 2.3%. So some pretty positive data there when it comes to both the consumer side as well as the industrial production side, adding to the picture when it comes to the key inflation gauge for Tokyo cooling to the slowest pace in 4 years. Complicated messaging for the Bank of Japan. This is Bloomberg.
The blistering rally in Samsung and SK Hynix shares has become an unlikely headache for some funds, with positions growing so large they're now being forced to sell under single stock cap rules. Let's get to Asia Equities reporter Winnie Su now. So, Winnie, are these cap rules one of the main reasons that we're seeing such big foreign outflows from Korean stocks?
Yeah, morning, Paul. Exactly. We are seeing these massive record outflows from South Korean stocks, even as Kospi has jumped nearly 100% so far this year. And a big part of it is that diversification rule, where some of these foreign funds can own just as much as 10% of their portfolio in one single stock. And you can imagine, as Samsung has rallied some 400% in the past year, SK Hynix jumping some 1,000%. That is really ramping up their percentage of the portfolio. And hence, these fund managers have to trim their portfolio just to stick with that rule. And Goldman Sachs actually estimating about $69 billion of the foreign outflow for the South Korean stocks actually coming through because of this diversification rule.
Where are traders looking to diversify, though, as the trim in exposure in Samsung and Hynix?
Yeah, so many of them for now are looking for these proxies. So proxies can be the affiliates, the holding companies, or even interests that have significant stakes in these two companies. And for example, we are hearing from GAM Investment Management telling us that they think, for example, Samsung Life is actually a good option, as it holds more than 8% of the Samsung shares, Samsung stakes. And you can see that shares are actually up some tripling over the past year. So that goes to show how investors are looking to diversify into these names. And some are actually looking at names that have less relevance to these two names. For example, the financial names. And they are saying that because the strength in the tech sector can actually trickle down to benefit the broader economy, and hence financials, defense, for example, can be a even better diversification options.
Bloomberg Asia Equities reporter Winnie Su there. Coming up, Bloomberg Tech Asia bringing you the region's cutting-edge innovations. In today's episode, we'll be unpacking the market potential, the challenges of scaling humanoid robots. You can watch at the times on your screen right now. Subscribers can also stream, via the terminal on TV Go. Market opens are coming up in Sydney, Seoul and Tokyo next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and we do have a tentative agreement, it seems, on the table when it comes to US and Iran to extend the ceasefire by 60 days, potentially also launching more negotiations and talks on the nuclear program, which we know was and maintains as a key sticking point.
Yeah, some red lines still in place for the White House. The Strait of Hormuz must be open, no tolls on that. Hand over the uranium, no nuclear weapons for Iran either. And while it's encouraging, there are signs of a deal. Still no actual concrete progress
Markets
yet.
have been wanting to run with this positivity over the past few sessions, and we saw the trading again at record highs overnight. The 60-day ceasefire extension seems to be plenty when it comes to continuing to push this momentum, particularly, Paul, as we continue to look at further gains across tech and AI. A lot of inflationary pressures starting to come into play now as a result of this expected continuation of huge amounts of AI spending. But that aside, this is the open as we get the Nikkei 225 coming online about 0.8% higher. Watching the yen there, we do have just a few remarks when it comes to the potential for further yen intervention. The finance minister making a few comments there in Tokyo, saying that there's no change in their positioning or their ability to respond to the currency market, but that they can take bolder action if there is a speculative FX move there. We're seeing dollar yen just hovering under that 160 level, which would trigger some of these concerns over intervention moves there. Switching out the board to take a look at Korea, which of course has been really home to some of the biggest moves that we're seeing this week with some of these names, SK Hynix and Samsung, for example. Samsung, though, claiming that lead when it comes to shipping those top-end AI memory chip samples. According to a latest story there, they've started shipping samples of the industry's most advanced memory to customers. It is an early lead for Samsung. They say that they've started shipping those first 12-layer HBM4E samples to major clients. So look for that reaction today in that Korean heavyweight throughout the course of the session, Paul.
Well, let's take a look at what's happening here in Australia. Also just open for trade, seeing some modest upside here, 0.7% at the get-go. Brent crude just opened as well, mirroring those slight declines that we saw for WTI, just off by a third of 1% right now, 93.37 for a barrel. I did mention we were discussing that tentative deal for a 60-day extension to the ceasefire. President Trump yet to assent to that, however. JD Vance, though, saying Iran negotiations are proceeding in good faith. We also had the US debt market open in Japan, and as you can see, zero change at the moment. We have seen, though, yields falling. The trend is down for the moment on the hopes of that end of the conflict, edging incrementally, very slowly closer, Heidi.
Let's bring up Pooja Malik as a partner at Nipun Capital. Pooja, great to have you with us. And I want to talk about this tug of war between the geopolitical situation and the AI and tech rally. But let's be honest, it's not really much of a tug of war at the moment.
Yes, although that varies depending on the day and the news coming out of Iran, right? It also depends on how strongly President Trump holds to his 3 red line criteria of no more nuclear development and taking away the uranium from Iran there. But having said that, you're right. The market is looking for an excuse to trend higher. And we're seeing it today just at the open, as you showed, with Korea trending 3 to 4% higher already. However, let's see how the situation plays out, because if oil stays above 90, which it is currently, that has real impact on inflation, on purchasing power for consumers, ultimately on GDP growth. So while the AI rally, both from a fundamental and a sentiment perspective, has a huge amount of momentum, the inflation risk is real. And if that results in interest rate hikes, that itself could act as a big break on this whole AI tech positive momentum.
Does it matter to you, or should it matter that it's still pretty narrow, what we're seeing across most markets, whether you talk about the US rally or what we're seeing in Korea? We obviously want to see a broadening of the rally, yes. But does it matter, I guess, for the longevity of what we're seeing, that it doesn't see that broadening?
I think it matters. It matters for longevity. It also matters for risk control. So earlier you were talking about how portfolio managers and fund managers have to sell some of these large Korean positions because they're crossing certain limits. And those limits are there for a reason of diversification. We're at a point right now where the entire returns of the Korean market are being driven by 2 stocks. The effective breadth of MSCI EM, although it holds 1,200 stocks, the effective breadth is only about 20 stocks. So it matters to investors whether they're holding a broadly diversified 1,000-stock portfolio or a very narrow, concentrated, risky 20-stock portfolio. And so it matters in terms of position sizing, Heidi. It also matters in terms of longevity, because this AI 20-stock trade in EM has become the crowded trade today. And we can talk why and how it got there. But given that we have a crowded trade with rising risk of inflation and interest rate hikes, you could see a very violent unwind of this crowded trade, just like we've seen the huge rally on the other side. So I think any small shift in sentiment could cause a rapid unwinding of this trade also. And that's why the breadth matters, because the narrowness has increased the risk of this rally.
Pooja, if we take a look at SK Hynix, though, yes, it's had a breathtakingly huge rally, but it's still trading only about 7 times earnings. So is there still room for this trade to get a bit more crowded?
It could, and especially because there are so many structural regulatory changes that are benefiting it. So, for example, earlier this week, Korea allowed the launch of levered ETFs, and there were 16 levered ETFs that are linked to single stocks, either to Samsung or SK Hynix, that were launched with a huge amount of retail inflow coming into these stocks. So investor flows and investor sentiment could result in these stocks seeing a leg higher, even though they have gone up anywhere from 4 to 10 times in the last 12 months. But the flow effect is very pronounced, coming from domestic retail investors that have a huge amount of FOMO right now.
So for investors feeling a little bit of discomfort about the concentration of some of these trades, where's a good place to go for diversification at the moment?
There's different places to see, actually. So if you still want to be in the AI trade, then investors are looking for companies that have exposure to Samsung or SK Hynix. They're looking at the pick and shovel companies. That's the next layer of stocks in Taiwan. But where we are seeing more opportunities, I think, is in China, where China is likely to see AI software winners, as opposed to Korea and Taiwan that have seen AI hardware winners. For example, if you look at the software stocks, and the largest two companies being Alibaba and Tencent, Alibaba's open source model is now one of the most downloaded models on Hugging Face today. If you look at their full stack AI deployment, going from infrastructure to apps to consumer apps, that they have the largest AI integrated play, and those stocks, if anything, have not run up like other stocks have. So I think for investors that want to be in the AI trade, there are other places to look, potentially next level hardware or even software. But we think in terms of true diversification, having a position in oil, in upstream energy, is also a good place to be, because along with AI, you are getting a huge amount of demand for energy, which is a structural long-term trend.
Pooja, I wanted to get back to the point of valuations, which is quite interesting. We've got this analysis at the moment looking at Micron, for example, right? It's the third best performer in the US markets this year, but relatively cheap when it comes to, I think, around 10 times valuations.
Yes.
There is a view that if you look at valuations for some of these tech and AI adjacent names, if there is softness there, is that reflective of a view that perhaps earnings potential has peaked, or do you see that as being an opportunity to add to that position and perhaps find something that's relatively good value?
I think it really varies from stock to stock. So like Paul was mentioning earlier, stocks like SK Hynix, TSMC, MediaTek, NVIDIA in the US, I think still have capacity to deliver very strong earnings growth. That is not true across a whole layer of stocks. So, for example, one of the things we've seen in Taiwan and Korea last year is that even loss-making companies were, returning 100%, right? And that is a problem. So I think when you get down to earnings, it's really a stock-by-stock story. But right now, what's fueling the trend is more investor sentiment and less earnings. And that's why there's a vulnerability in the trade right now, despite performance, because sentiment is really bordering hype at this point.
All right, Pooja Malik, partner at Nipun Capital, thank you so much for joining us today with your insight. And we do have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching in Japan. We had really a flurry of data. A lot of quite positive, actually. Retail sales were a beat. Industrial production was also a beat on expectations as well. The read-through when it comes to Tokyo inflation was an interesting one. It was sort of the key inflation reading cooling to the slowest pace in 4 years. It's really complicated messaging for the Bank of Japan policymakers that may want to try and justify a hike as early as next month. We are seeing some upside when it comes to these markets, of course, being driven really as we continue to see that tech-driven rally, but also the developments on the extension of that ceasefire. Dollar yen not doing terribly much, some sort of jawboning, if you will, from the Ministry of Finance, which faces some tough decisions. Should we see further weakness in the yen? Let's bring up Bloomberg FX and rate strategist David Finnerty. So, David, we did hear from the finance minister. Look, nothing new other than saying they could take bold action if they see speculative big moves in FX. We're just hovering around that 160 level. Fundamentally, though, we always question the efficacy of any intervention measures anyway.
Yeah, I think we should tonight get the MOF intervention data out, so we'll have an idea of how high or how much they intervened back on basically April 30th, and basically through May the 6th. Looks like another potential intervention date. But as you said, look, the irony is back on April 30th, we were 160.72 was the high, went down to 155.04 over the next few days, and now we're back up to 159 plus. So the point being, the rebound has been very quick indeed. And the question therefore becomes, as historically it's been proven, is any intervention, how long does it last? Is it worth it? I think at the moment, the question is, we're back in this era. The market's very wary of further intervention, particularly the closer we get to 160. But then the question becomes, is even if there is more intervention, does the market go, you know what, this is an opportunity to buy it lower down and see it rise back up again? So the market is really questioning, how efficient this potential intervention, yet to be clarified later, has been. And as I said, ironically, they may go, actually, we're quite happy with it, just to buy the dip and see it rally back up again.
David, something that might support the yen could be BOJ tightening, but let's take a look at these inflation reads we just got. Tokyo CPI slowing more than expected, mirrors the national figure that we saw back in April. Is the window closing, if not closed, for the Bank of Japan to normalise rates?
Yeah, the data's certainly not what the Bank of Japan wanted to see, whether it be the headline number or the core numbers. It certainly came in weaker than expected, and compared to the prior month, lower. So the trend, even the very short-term trend, is not where you'd like it. You obviously like those numbers going higher. The catch for the BOJ is it's sort of painted itself into a corner. You had three dissenters at the last meeting going, look, we think there should be a rate hike. The market's priced in basically 77, 78% chance of a hike in June. It's nearly fully priced in by July. So if you don't deliver that, then the market gets obviously disappointed, and that puts pressure on the yen. So then you do go above that 160 level, forcing potentially more intervention. So I think even though the data may be like not what the BOJ wants, at the end of the day, it said, given its recent rhetoric, given where the yen is trading, I think the market's going, look, you really have to hike now, and we're looking for another hike maybe by year end. If you don't deliver that, certainly in the next one or two meetings, but ideally I'd say the next meeting, that the market will be disappointed. And we've seen historically on any central bank, if the market's disappointed by you, it will move very quickly. In this case, that would mean a weaker yen.
All right, Bloomberg FX and rate strategist David Finnerty there. Let's get to the top global headlines that we're following. The leaders of the Philippines and Japan have agreed to begin talks on military information sharing, as well as discussions on the delimitation of maritime borders. President Ferdinand Marcos Jr. made the announcement after meeting in Tokyo with Prime Minister Sanae Takaichi. Both countries are security allies of the US that have expressed concern over China's growing military power. The US and Iran have reached a tentative deal to extend a ceasefire by 60 days and begin further nuclear talks with Tehran. A source says President Trump has yet to agree to the terms. Vice President J.D. Vance says the two sides are going back and forth on some language points, and Tehran appears to be negotiating in good faith. Axios is reporting that the deal includes unrestricted shipping through the Strait of Hormuz.
The teams have been going back and forth, and President Trump has made it very clear, he talked about it at the cabinet meeting, that he has several red lines. And Iran has to turn over their highly enriched uranium. They cannot pursue a nuclear weapon. And the Strait of Hormuz, back to your question on energy, has to free transit. Navigation of the seas has to be free and open as it was before. So he's not going to take a bad deal. He's going to make a great deal for the American people.
Japanese trading house Mitsui is looking to invest in liquefied natural gas projects across the Middle East, the US and Australia to meet rising power demand from AI data centres. Speaking exclusively to Bloomberg, CEO Kenichi Hori also called for an urgent reopening of the Strait of Hormuz.
Yes, we need to make sure that the safe passage of vessels is resumed, and the Middle Eastern countries are going to continue to be the critical suppliers of energy products to the global markets. We cannot forecast when that will be resumed, but we just hope that we see an early recovery there.
What will give you confidence?
Safe passage of the vessels and geopolitical stability.
In the meantime, your U.S. gas business is a big driver of earnings at the moment.
Yes.
How are you doing there?
At the moment, it's doing as planned, perhaps a little bit above our plan. We do have investment in shale gas itself. We also have investment in the liquefaction facilities. So it uses U.S. natural gas converted into LNG. We also have chemical plants that convert the natural gas into gas chemicals, such as methanol and ammonia. And we have vessels, dedicated vessels lined up for the export part of these molecules and also for LNG. So it's a long supply chain, and it starts from the natural gas produced in North America.
Is your business there enough, or do you have more plans for expansion?
Always looking for expansion opportunities, yes.
In what sectors and where?
In LNG, and also for the gas chemicals that I talked about. We are working on a ammonia project. The sequesters its carbon emissions, so it's a clean ammonia. That's another project that we're working on in the United States.
How big is your U.S. business compared to the rest of your of Mitsui, and what's the plan of like expansion?
The U.S. business represents more than a quarter of our net earnings at the moment, and our policy is to our plan is to expand it further.
How has the war in Iran and various geopolitical flashpoints around the world in recent years perhaps changed the global energy dynamics, when a lot of these issues such as sanctions perhaps are being put on the back burner because the world desperately needs fuel?
The world desperately needs fuel, and the world needs to have more production sites that are reliable and competitive. So this is now an equation of trying to add more sources. And the Middle Eastern sources will continue to be very important. I think it will continue to be critical to the global supply. And with this with the situation in Iran at the moment, the long-term supply-demand situation will tighten. That means that we need to have various projects that are in the works now to be completed, so that the energy industry can continue to meet the rising demand for energy.
Which is why you're traveling so much. I mean, before we started this conversation, you were telling me you're going to Australia, you're going to Latin America, Europe, so forth. So where are you diversifying?
Yes, we're diversifying into all parts of the world. For our LNG business, of course, Middle East, North America, Australia, and Africa as well.
What are the bright spots for your business?
The bright spot for our business is that for energy, there's a clear demand for growth. With the advent of data centers and the necessary energy for compute, clean, affordable, and sustainable energy is really key. In order to make that happen, we need to be part of good projects that have a lot of quality reserves. So we're fortunate to be in such situations in some of our assets. So I think we're in the right direction.
Because of the need for these power-hungry data centers, perhaps, as you mentioned, the advent of artificial intelligence, we are seeing some governments also trying to rein in these exports, like Australia when it comes to gas from 2027. Do you expect more governments to try to keep their energy security within their borders, and what would that mean for Mitsui?
I think the governments, most governments, are very true to the commitments they made to the global markets, so for their export permits and for their export activities. And I think it's also natural that the players are mindful of domestic demand as well. Mitsui in Australia works on both ends. We also develop gas for Australian domestic use, and also we export gas for LNG. So I think for us, we like this balanced approach.
That's Mitsui CEO Kenichi Hori speaking exclusively to our colleague Sherry Ann there in Tokyo. Well, let's take a look at how risk assets are performing, particularly Brent. Interesting moves today. We're pretty much back to where we were at the close at the moment. We have had some encouraging news, although we've had encouraging news in the past, that there's a tentative deal on a 60-day extension to the ceasefire between the US and Iran. This is according to US sources. JD Vance says Iran negotiations are proceeding in good faith. 3 red lines remain for the US. Open the Strait of Hormuz, no tolls, turn over the enriched uranium and don't pursue nuclear weapons. Not really moving the oil price there, but S&P futures ticking up just a little, and we're seeing the MSCI Asia Pacific Index continuing to put on a pretty strong showing. We're up by almost 1%. We have more ahead on the Asia trade. This is Bloomberg. The top corporate stories that we're tracking. Anthropic has raised $65 billion in its latest funding round, valuing the company at $965 billion, eclipsing OpenAI for the first time. Sources tell Bloomberg that investors included Amazon, Google, Micron, Samsung and SK Hynix. Anthropic also says it's planning a broad release of new AI models in the coming weeks after developing stronger safeguards for models that earlier deemed too dangerous for the general public. Haidi.
Bloomberg has learned that Apollo and Blackstone are working to bring additional investors into a roughly $36 billion debt financing deal to help Anthropic build out its AI infrastructure. The debt will be used to purchase Google's custom TPUs, which Anthropic would then lease with Broadcom backstopping payments. It's set to become one of the largest ever private credit deals.
Dell shares soared in late trade after its full-year sales outlook far surpassed analyst estimates, fueled by demand for servers that power AI work. The company sees fiscal year revenue reaching about $167 billion, and that includes $60 billion from AI servers. COO Jeff Clark says the AI opportunity shows no signs of slowing.
Japan's Taiyo Yuden says demand for its AI server components has hit what it calls scary levels, straining capacity and raising supply chain risks. The CEO, Katsuya Sase, told us that the pressure is extremely intense as the industry relies on a handful of suppliers, leaving it exposed if one falters. And a key maker of NVIDIA servers is also sounding the alarm. Taiwan's Maiwon is warning of shortages in key components beyond memory chips that could slow or raise the cost of the global AI build-out. This is what we're watching when it comes to trading here in Asia. In Korea in particular, we're seeing upside across the board when it comes to some of these chip-related names. Samsung, of course, with that further sort of bullish signal, as it says it's been shipping out samples of its latest 12-layer HBM4E to clients there. First sort of off the rank, if you will. We're seeing some upside there. Elsewhere, some of these robotics as well as other chip names are also extending the rally. Well, Bloomberg Tech Asia will be next. We'll be live from the Tokyo Humanoid Summit as we look at the market potential and challenges of scaling humanoid robots. This is Bloomberg.